Thank you, Cameron, so much for coming on the Reality Realty Podcast. I appreciate you taking the time. I know that you're a busy man. We first got linked up when I started with Remax about a year ago, and you tried to get in touch with me, and I didn't mean to ghost you, but I kind of did. So I apologize for that. But besides that, you've moved on to bigger and better things, it sounds like. I'm excited to hear all about it. So maybe just introduce yourself and then we can roll into the questions.
Yeah, Kevin, thank you so much for bringing me on to your podcast. I think this is probably one of the best ideas, trying to get information out to people whenever possible. I've been in the lending industry for roughly about 10 years, and I got my feet wet in the depository setting. So I was working for banking institutions where I got to handle a lot of different loan types, lending situations, and it definitely allowed me to master my craft. I switched over to CMG, which we had that joint venture between Remax and CMG Financial, and I was there for like 3 years where I got to know your team and stuff like that. And it was one of those things where CMG we just do so much for our clients that most lenders just don't offer. That it was one of those things I had to stay with this company. So my biggest thing was just we're changing people's lives through home ownership. And my goal is just to be there for my clients whenever they need me and to provide them with options that just nobody else can provide them with.
I mean, that makes all the difference. Like if someone's going up and trying to find, a lender, like that's probably the number one thing they're probably looking for is your option or what you can provide or, get for them. And so I think that's probably a smart move that you go with as much as you value you can, give is basically what it sounds like.
Yep. It's all about value, options, trying to be a solution maker. So it's one of those things when things get kind of interesting in the lending realm, having your plan A, plan B, plan C. Our goal is to get our clients into owning a home, and how we go about making it happen. We want it to be a nice, seamless transaction. So working with somebody who's well-developed, who's seen a lot of different loan products, who offers a lot of different loan products is one of those key factors that I think having a solid lender on your side is really, priority number one.
That's awesome. You have something to share with us today, so I can't wait to hear about that. I don't think people realize that there's so many different options out there. People, there's the standard conventional and FHA. People are realizing that it's very cool to be able to hear, especially what the things that they're able to do, you guys are able to do these days. It just amazes me because I didn't even know that was possible. So it's pretty cool.
Yeah. When I first joined CMG, I was shocked, coming from depositories and working for the banks. They offer all the different loan products and things like that. And that's what most lenders do. They generally are offering your FHA, VA, first-time home buyer products. It was only when I came to CMG, I was kind of like, wait a minute, what is this? These are loans that have been around a long time. And I didn't realize it until when I started working with this company, that was kind of like, wow, if I had known this some years ago, I would be in a completely different financial path for my future.
All right.
Completely different. And so I think that's probably why I've taken such a liking to the company. I believe in our CEO. Our CEO is one of the greatest guys I've ever known. And that's just from him doing his podcast or at least our meetings and stuff like that. The guy's a very down to earth. His name's Chris Michael George. Super great guy. Yeah, I met him once before just through a Teams meeting.
Okay.
But I trust him to make the right decisions for our organization. But man, he traveled outside the country and he found out about these loan products. And that's how this came about. He brought him back to the United States. And that's
very cool.
How it came about. So
he's forward thinking, always out there trying to do better. That's awesome.
Outside the box thinker. It's like, all right, let's do this.
Yeah. It doesn't sound like he's one of those guys that just waits for things to come to him. He sounds like he makes it happen. That's pretty cool. I love to work for people like that.
So, and they just took in a banking institution. So we will be in all 50 states. Eventually I'll probably have a federal licensing down the road.
Cool.
That's something that'll come up in the future too.
Is that a long process for you to do?
No, that's the easy process. If you're working under a bank, your licensing is federal. It's not like a state specific licensing like I am right now.
Yeah.
So I'm state specific licensing, but I'll be federal again. All 50 states will be part of my licensing again, which is great.
Yeah, that'd be cool. That's always a plus. But you can get loans all throughout the country. You just can't do business or do the loans outside of California.
Yeah, exactly. So, the way it generally works is we can't be loan specific for clients that are talking about their specific situation, their specific loan outside of the state unless we're licensed there. But we have ways of working with our clients regarding that. So we have teams that are licensed in all 50 states. So that's never been an issue.
Yeah. Oh, yeah.
Yeah.
There's no way you guys are going to pass that
No,
opportunity of that's
exactly.
money out the door.
Yep, exactly.
Well, awesome. So how did you even get started when you were doing the deposits? Like, was that something that you just decided or just found a job out of college or something like that? Or
I never thought in a billion years to be a loan officer. Yeah, it's
yeah,
funny.
right.
I talk to real estate agents. They always tell me the same thing.
Right.
So when I was real young, I actually was a first responder. I was a volunteer
Oh,
firefighter
cool.
for quite some time. And
Cool.
I was kind of leaning more towards law enforcement. But this was like early 2000 before the downturn in the economy.
Yeah.
And then they ended up having hiring freezes. So it was one of those things where I've got a background with all sorts of stuff from the hobbies I've been involved in, the
Mm.
type of employment I've been in. And if anybody knows, sales is one of your best options to make a life for yourself. And so I ended up getting hired for a telecommunications company, Verizon Wireless, and I worked there for like 9.5 years. And
Company
I
work for?
yeah, I worked inside the stores. Then I got into telecommunication, telephone sales, and then I became a business sales. And at the time, it was just one of those things where it's like, hey, I want to try something a little bit different. And
Yeah.
it just kind of came about that somebody had offered the option of becoming a loan officer. And so I read more about it and decided that was the direction I was going to go. And here I am today.
Crazy how things work out.
Yeah.
You know, it's the last thing you expected, but it's like you love it, sounds like, or you're good at it, sounds like. And so that's pretty cool. Just
Well, it's wild because, it's like when you're in law enforcement or a first responder, or if you're a firefighter, your biggest thing is you're helping people. In mortgage, it's the same exact thing, just differently. Not dealing with an emergency.
yeah, yeah.
We're dealing with the good parts of their life.
That's a
It's
good
like the
point.
same thing,
Yeah.
in a different light.
You also wear a lot of hats too as a lender. You literally are like a therapist too, and I'm sure people are always trying to call you and talk to you about other stuff because, if they can trust you with their money, I'm sure we can trust you with a lot of stuff. So it
I
goes a
get
long
called
ways,
like 10 o'clock at night, and if they're calling that late, I know there's something on
There's
their
a
mind.
reason.
I pick up the call, and they're just like, Cameron, why are you picking up the call this late at night? It's like, if you're calling me this late, there's got to be something on your mind. And so I can go and
Sure. Because both of us aren't going to sleep tonight.
No, exactly.
That's cool. I mean, sure, you've had building those relationships, it's probably been, as a real estate agent, as I've learned that's like one of the biggest jobs in our field, especially in sales, like just those relationships with people. So especially the higher dollar you get, within loans and like for houses,
Yeah.
or selling houses, that's a big, if not the biggest transaction or purchase people will be making in their lifetime. So
Yep.
it's a reason why, it's very cool. You're absolutely right. To be able to help. I've never been able to help financially, but it just feels so good to be able to get across the finish line all together with a lender and the client. It takes that cohesive working together with a lender and the real estate agent. A lot of things can come up and people don't realize that. They're just like, well, I'm just going to go find a lender because so-and-so said their aunt is a lender or something like that, so it goes a long way to be able to help. And so for people to be able to work with someone like you would be awesome. I hope we get the opportunity someday soon.
Yeah, same here. I get that quite a bit where a lot of times, because people are not in the know of what is out there as far as loans are concerned, that's where I try to explain to people. I think the first thing you always need to do is start shopping lenders before you do anything, because they're the ones that are going to be working out the numbers. They're going to work with you on your budget. If you got the right
100%.
lender, they're going to offer you some solid options, not just your basic options. It's like, no, you've got more options than you realize. And if something does come up, maybe we'll have to take one of those options. So, yeah, I think just having the right person on your side is the key.
Yeah, that's awesome. It feels really good to be able to know that you got someone on your side.
Yeah.
Well, maybe we'll you want me to get into the questions? You good with that?
Yeah.
All right, let's get it going. So for someone completely new to buying a home, what's the very first step they should take?
Yeah. So number one is always contacting a multitude of different lenders. When you're communicating with lenders, what you're trying to do is get a feel for who they are, their knowledge about real estate and lending. Do they take control over the situation if necessary. Things can happen, and us as lenders turn out to be the mediators that go between to find ways of making it work. The biggest thing is just trying to find the person who's going to be in your corner, making it happen. The biggest thing that I would suggest is you want to search out what are your loan options and not stick with just your regular conventional FHAs. You want to be an open mind, like what can you offer me, and see what that lender can do for you. But at the end of the day, our goal is to get you into home ownership. If something was to come up, then hopefully that lender gets you to the finish line and funding.
Absolutely. Isn't it true that like they go to someone like a mortgage broker like yourself, or compared to a bank? Like you walk into a bank, they're going to give you their one rate and the three types of loans that they have, like maybe if they even have VA, but FHA and conventional basically. And then, so like the difference, right, is you have a lot more options, right?
Yeah, exactly. That's where asking good questions. I get a lot of first-time homebuyers are getting smarter. They're writing down good, solid questions. When they call me, they're like, hey, Cameron, I've got this question, I've got that. How can we make this work? The other thing too is when you're taking these first steps, if you have a really good lender, like for me personally, my goal is to put people into a comfortable lifestyle, and not put them into an uncomfortable lifestyle. And what I mean by that is I'm looking for what is a comfortable monthly payment? What does your budget look like on a home? And it comes down to like the types of questions that a lot of my first time home buyers are now involved with. It's huge because it makes them more educated, it makes them way more informed. I think the biggest thing is just shopping for the right lender, getting your feelers for them, seeing what kind of options they offer, so that way you are as fully informed as you possibly can be.
So how does it work as far as when it comes down, like a lot of people are worried about running their credit, and especially that they don't realize that they can shop around for a loan. Even if they do run your credit, it's a different type of like, like you have, how's that work? Like how long do they have to shop around, and how many or does it hit your hard pull on your credit every time, or how's that work?
Yeah, so there's a couple of ways we can do it. If they're looking at getting like a full approval, it does require a hard credit pull in most cases, but we do try to stick to more of a soft credit pull to at least get our feelers on what the circumstances are. In general, most lenders are going to do a soft pull to get the ball rolling, and then later on we'll do a hard pull. So there's no impacts on your credit when we do a soft pull. And generally when you do a hard pull, it's really not that impactful. The credit bureaus recognize that you're probably shopping around. And so you might have your credit pulled a couple of times, but you definitely want to steer clear of like having it pulled too many times, because it will impact it more.
Sure. Yeah. But like I'm glad you said that. Like that's what I was trying to, the credit bureaus like know that you got to be shopping around. If you're having these lenders or banks pulling your credit, then obviously they should know. But too many times it's just gonna take, I don't know how big of a hit it goes on your, but it only doesn't last that long, right? Because it's a mortgage.
Well, as lender, so for the lenders, we're usually looking for, 120 days or 4 months, basically, of any credit inquiries you may have had your credit pulled on. And then we have to verify why you had your credit pulled. It's generally 4 months, but we can see it for even further.
So can you explain the difference between pre-qualification and pre-approval, and why is one more important than the other?
Is basically stated income through your application, and we do again a soft credit pool. So you're just going to provide us with general information regarding your income, how much income do you make, what your bank statements look like, but nothing's been verified. So it's more or less just this is what I have, and those are things that when we're trying to move really, really quickly, that's the startup of the process. When you get into the pre-approval stages, there's actually two different versions of a pre-approval. So the first process is a standard pre-approval where you're providing us documentation to the loan officer. The loan officer is going to take a look at your pay stubs or bank statements or tax returns. And then we're going to take a look at your actual bank statements to find out, are there any large deposits? And then we run the system to find out, are you approved based on what we entered as a loan officer? The caveat with the loan officer pre-approval, and this is what most people do, is they just send out a standard pre-approval, is things can still be overlooked and mistakes can still happen. The next step above this is, and this is what I do for every single client of mine, is as soon as I get them all of their documents. And keep in mind, for me, I actually look at things almost like an underwriter. So I don't just collect your standard docs. I'm actually collecting letters of explanation. I'm verifying your deposits. I go well past your basic documentation collection. So my clients are like, boy, that's an awful lot of documents. But the reason I do that is because when we're in contract on a home, we've already addressed all of this stuff. So you are now down to almost the finish line. You're just focusing on the home and not the documents. And so by doing that, we go to the next step, which is submitting it to an underwriter. Now the underwriter is getting their hands on it. They're going to look at the documentation. They're going to provide me as a loan officer with whatever additional conditions there are.
Right.
No conditions possibly if it's a really clean file, or if there's a red flag or concern, we now have that at our beck and call, resolve that. Yeah, to stay ahead of it and resolve that issue. So if it's a real question mark, we're going to get it resolved like ASAP. So that's the key with an underwritten pre-approval is, one, your loan's going to go quickly, but two, I would say the biggest factor actually is just we caught everything. So our T's are crossed, our I's are dotted. It's a clean file. When we give that to a seller and to the selling agent, when they see an underwritten pre-approval,
I love that.
That's like golden.
Yes, that's huge. As a listing agent myself, that holds a lot of weight because that is such a big barrier to overcome during the transaction. So to be able to know that issue is not to be worried about before you even go into contract is huge. And so sellers love that.
Oh yeah. Yeah. And on occasion, like I had one just the other day where it's like, everything's looking really good. When we did our verification of employment, there was unforeseen contracts and terms that were tied to the employment that we caught. And now the underwriter's like, we can't use that income. Mm-hmm. So on the initial documentation, everything's looking good. But when we start getting into the verifying and taking that next step forward that you wouldn't normally do, that could have posed an issue if we were in contract on buying a home. So we caught it a step early. So now we have a game plan to get them into home ownership. Might not happen right now, but we have a game plan.
That's big. Yeah, those pre-qual, that's a good way to put it. Just a stated income. So you can, yeah, those don't hold weight at all. I mean, they're good to have. I mean, it's a first step type of thing, but that pre-approval needs to come quick. Right after that is basically, that's just buying you like a day or something.
Well, the other crazy part too is when you get into underwritten pre-approval, that's a super fast close because everything's done. All we have to do is get the appraisal taken care of, follow the 3-day wait periods on the front end and the back end, and we're already in closing. So that's when you can close those 12-day closings. And
so that's the other thing, which also, your offer's coming in super strong because regardless of the price, you're fully underwritten and you can offer a shorter contingency period for the loan or for the whole escrow period. And so
exactly
that's huge. That's very huge. Yeah. So what are some common misconceptions or myths about getting a home loan that you often hear from first-time buyers?
Well, the main one that most lenders are always going to say, down payment. So, they're like, yeah, most buyers are like, I need a 20% down payment. But I think a lot of people are starting to understand now that you don't necessarily need a 20% down payment. There's plenty of down payment programs out there that, you can come up with a 3% or a 3.5% down. You got VA loans where you can do 100% financing. You've got down payment assistance programs that will cover your down payment. And some of my down payment assistance programs will cover your down payment and closing costs. So you can come in with relatively no money. But it all comes down to what kind of product you're looking at. Again, then I have other loans that is a whole other conversation, but the down payment is really one of the main factors that people always ask me about. The other one that I see a lot of, and it's really interesting, is going back to the first question where searching for the right lender is the key. A lot of people tend to call and say, can you give me what your interest rates are? Because I'm looking for lenders. And one thing that they don't understand, that rates change every single day. Yeah. And whatever the rate is today is going to be different months from now when they find a home. Also, lenders are doing different things at different times depending on what they're trying to accomplish. And because there's two parts to a rate, you've got your index, which adjusts with the Fed, and then you've got your margins, which is what the lender charges to do business, so to speak. And they have to change it up or down depending on what they're trying to accomplish. And so they might reach out to one lender and the lender is going to have a much higher rate than another lender. But what they don't realize is they're going to go with this other lender that might offer a lower rate at that time. But 2 months from now, it could be completely flipped
I
working with.
see.
So I try to explain that to them, that it comes down to the lender you want a working relationship with more so than anything with today's rates. Depending on the circumstances, they're probably going to refinance it in the next 2 years anyway. So I would say what's more important is try to find the right option and solution for you and find the right lender to work with and not be hung up on the interest rate.
Yeah, that's got to be tough for people that are like numbers people, so they're just always, like you said, they're rate shopping. But if they actually fully understood, it's what it sounds like, that they just, I got to get in with the right lender and who knows what they're doing, because that makes all the difference.
And there's a lot of smoke and mirrors interest rates that lenders will put out there, because
Sure.
keep in mind, when they make a phone call, they're like, what's your rates? Well, they don't have to technically disclose it to you.
Right.
When you're in contract and you're purchasing a home, they have to send you a loan estimate, but it could be a smoke and mirrors type of interest rate also. So yeah, they won you by lying to you to start with, but then down the road, they're going to still work with that lender because they offered a smoke and mirrors rate, but now the rates are different. And they're like, oh yeah, because that was 2 months ago. It's a different time now.
Yeah.
Not a good way to start
No.
a relationship, a long-term relationship.
No, that's like crazy. And especially, I'm sure, the bigger the company, the easier it is for them to get away with whatever they want. And it always feels like
You
those.
gotta be careful too. Everything's federally regulated, so it's one of those things where you just gotta mind your P's and Q's, do what's right for the client, operate with ethics, integrity, and at the end of the day, just be there for your client.
For sure. That's awesome. I mean, I'm sure that you've probably heard a lot of crazy stuff coming out of first-time buyers' mouths, but it's probably a lot of the same stuff over and over, just in different waves, it sounds like.
All sorts of crazy stuff.
It's just that big unknown, like that people, I totally get it. Like, if you've never done it before, you're only going off what other people say. It's really hard and it's really scary and it's intimidating. So when people want, like, do you know a guy or can you refer me someone? Like that goes a long way. So like, but someone good like yourself, it doesn't take much like for your name to get out, because when they know that you do good, then they'll just keep coming back and then referring family and so it's a good business to be in if you're good at it.
Yeah, if you're not good at it, people are going to find out quickly. And you burn a lot of bridges in this line of work. So, and there's not that many of us at least licensed right now. It's 2025. And unfortunately, a lot of people hung up their license just because of the economy and stuff like that. So it feels like kind of like the lenders who have kind of hung in there up to this point. They're the better lenders, the ones that know what they're doing. And
100%.
so I think that says a lot for those who are still doing this today.
I agree. Yeah, you're absolutely right. Because like anybody could sell a house or, do a loan to anybody back when the rates are awesome and, everything's being great. But when times are tough, that's when the veterans, the ones that know what they're doing, are actually doing just fine because they established their roots a long time ago. And so it's pretty cool to see you guys do all that. There's quite a few of you guys that are around Remax, and the people that I've met, the lenders and stuff, you guys are all been around for a long time, and it says a lot, obviously.
It's definitely, you can kind of just jump in and become a lender. It takes some experience and trials and tribulations to figure things out, and
sure,
I've been very, very grateful that people have given me the opportunity to serve them. And at the end of the day, it's like, I've had some pretty wild things that have popped up and resolved pretty much a majority of them, if not all of them. But yeah, things can come up and it's just how you handle it.
So beyond the interest rate, what other fees and costs should a home buyer be aware of when taking out a mortgage?
Yeah, so a lot of the lenders, there's different types of fees that they add up together. Some of them might have just one fee. They call it like a loan origination fee.
Yeah.
A lot of lenders will have like 2 or 3 fees. Like one will say like underwriting, admin fee, processing fee. Most of them are pretty competitive. They could be off a couple $100s here and there between the different lenders. So there's that fee. All the rest are going to be third-party fees that are tied to either the title company, even like the appraisals and stuff like that. It depends on the appraisal company that the lender's using, but that's also a third-party fee. It's technically not the lender's fee specifically. It's just whoever they're using. The other factor is when you get into like down payment assistance programs. So down payment assistance programs, those are bond programs. So they have their own set of fees, and there are significant differences between the different lenders in that regard. So if you're looking at some sort of a CalHEFA program, GSFA program or a CD program. You want to find out like what are your fees associated with the bond program, so that way you're familiar with that, because they are exorbitant depending on which company you're working with. So when I did work in the banks, they had their fee, which was different than where I'm at with CMG. Ours is pretty competitive, but yeah, you still want to find out what the down payment program looks like in that regard. And then some of my other loans, because they're one-off type of loans, those are priced completely different. They're priced a little bit differently, but there's charges that are associated with the loan that's different in those loans. But it depends on what we're trying to do. It depends on the loan product. So you just want to the buyer should contact the lender, find out, hey, this is the type of loan I'm looking at, or what loans do you offer? Send me those options, and then ask more questions as the buyer, like, okay, can you tell me a little bit about the fees that are associated with it, just so you are in the know. But for the most part, you really won't know any of the you'll know some of the fees. You'll know what the rates are, what the cost is on the rate, what the loan origination fees are. But as far as closing costs as a whole, you're not technically going to know the full details of that until you're in closing. We'll give you an estimate, and we usually throw everything at the buyer to play it safe. But once you get to closing, it's going to be balanced between the title company and the lender. So I try to tell people, it's like, don't take things with a grain of salt just yet, but you definitely want to make sure your rate, your cost for the rate, origination charges, all that checks out. So that way, your loan's good.
Yeah. One thing I've heard people ask or wonder when I am always saying, like, go to a local lender that is a broker and not to a bank, they're always like, well, they cost more. I'm like, I don't even know what they cost, the comparison. All I know is they're saving you so much more money in the long run as far as what the loan and what your situation. You're
Yep.
not going to get that with a big box bank or big box lender. And so I don't think people realize that. And so they're always just worried that you guys are just, I'm not, of course, we're all in the business to make money. Like they got to make their money too. But they're not like taking you guys, one by one for a certain amount.
And so I tell people, it's like, everybody always tells me, I'm so sorry I'm asking these questions. No, any question is a good question. So you don't ever worry about that. And it's always a good idea. Just shop around, get your feelers, ask those kinds of questions. What are your fees associated with it? What do you offer? What do you do for me? And it's like, at the end of the day, it's like, this is your guys' loan. This is your purchase. Just be informed. So that way, when you go into it, you should come out satisfied once it's done.
Yeah, there you go. It's a better feeling like, what did I just do?
It eases the stress. This
Yeah.
is not rocket science at the end of the day. We're just helping you buy a home, and just follow our lead. We'll guide you.
What about credit score? How important is my credit score when applying for a loan, and what's a good score to aim for?
Yeah, so the rule of thumb is the higher the credit score, the better. So everybody's different. I deal with all sorts of walks of life and different circumstances. Ideally, there are loan programs that can allow you to get into homeownership with you being in the 500 range, okay? Obviously, the issue when you have lower FICO scores is you're going to have a more impacted loan. So interest rates are going to be impacted. Certain loans you might not even qualify for because of your FICO score. So FICO scores are very, very important as far as the overall characteristics of the loan. Ideally, if you're over a 580 FICO score, we're going to find you a loan at that point, as long as the circumstances of that FICO score are not against guidelines. So we look at the different guidelines depending on why your FICO score is in the lower category, and then we work with our underwriting to see if we can make it work. And if not, we try to help you for the future to get it improved and get you a position to owning down the road.
Yeah, so you work with them, try to get so like if they're not quite there yet, you can tell them like, if you do this or this or take this off your credit, then we'll get you here type of thing.
100% bureau,
Sure.
so to speak, or credit repair agency. We do our best to explain to them why their credit is the way it is. We'll give them some ideas on how to help them improve it, but we always try to recommend, if you do talk to a credit repair agency, that will speed that process up. And I've had people, it took like 2 years to get them through the process, but now they own a home. So again, the end result's always the same. We'll find a way to get you into a home ownership. It's just a matter of time.
That's huge, because what's 2 years, honestly? Like, and at the time, it might seem forever, but by the time you are all said and done, you're like, oh, I'm in a house now. Like, it's all worth it.
Exactly.
What are some red flags or things a first-time buyer should watch out for during the loan process?
Establishing new debts is the big one. A lot of my clients, I give fair warning to my clients, do not establish any new debt. I have had people purchase a new car.
That's what I was.
Nope, you
Don't go
swear.
shopping for
Yeah,
cars.
go shop. I had it happen. A client of mine, he ended up buying a really nice car. It had a significant impact on the monthly payment and his debt ratios. And so we had to postpone it a little bit because we had to add a co-borrower to make it all come together. But yeah, don't shop, for any sort of debt. Sometimes people want to purchase furniture early. I'm like, listen, let's wait for the keys
For real.
before you start placing orders for like anything that's going in the house. And then the other part would be like changing jobs in the middle of your transaction. I've seen that a couple of times, and thankfully they give me kind of like a heads up. So I'll tell them it's like, no, we're going to wait for you to do the transition to the new job, and I'll guide you through, the process on making that work. We can still make it work. We just don't want it to happen while you're in contract,
Sure.
because those processes can take, 60 days sometimes to fulfill that. Just tell the lender if you're going to do anything.
Yeah, when in doubt, like if you're gonna buy anything with credit, do not do it. Like when in doubt, just don't do it because it'll blow your whole deal up.
We just assume they're like, I'm just going to go ahead and do this. No,
Yeah, I don't think you
it
realize
doesn't
what
work
you're
that
doing.
way.
I'm sure you've heard some stories too, like why they thought it wasn't a good idea. I can only
Yeah.
imagine.
The last one I had was pretty wild. I get it, but it's like bought a really nice car. So
That's cool.
yeah.
Guess he didn't really want the house yet.
Well, it was on a refinance, so, but
Oh, that's
the guy
good.
was super cool about it. He was just like, I guess I shouldn't have bought the car just yet. I was like, no, rodeo, I know
Yeah,
what
I see.
happens. Yeah.
Whole different. I just remember like being told, every time either you refinance or buy a house, it's like do not go buy. So,
Yeah, cut up your credit cards,
all right, so here it is, man. This is what really interested to hear about is the all-in-one loan, and how is it different from a traditional mortgage? Is it a good option for everyone? And disclaimer that the all-in-one loan is a registered trademark of CMG Home Loans, NMLS number 1820, all rights reserved.
Yeah, it's Chris Michael George. He was traveling overseas, and I believe it was Australia.
Cool.
When he was over there, he found out about this loan. So when he came back to the States, apparently there's a couple of countries that's the only loan they technically offer, but he ended up reaching out to a bunch of servicers, and we ended up getting 2 servicers who manage our all-in-one loans. When I found out about this loan, I was shocked to find out what it can do for our clients. I'm going to try to keep it straightforward in this case because obviously we're stretched for time. Yeah, I'm just going to go straight at it so that people understand what this loan is. So there's a lot of misconceptions or misunderstanding, especially in the financial side of things. I'll dive into that too. But most of us are accustomed to a traditional type of mortgage. An amortizing loan is basically a front-loaded interest payment over the course of a prolonged period of time, 15 years, 20 years, 30 years. And they have an amortization scheduling that accounts for how much interest is going to come out according to, and because it's prolonged out, you're front loading all of your interest for usually the first 16 years where, over 50% is going just towards interest alone. And then finally it switches and now more money's going towards your principal. So a lot of people freak out when it comes to interest rates and things like that, which is for good reason. So interest rates impact your overall monthly payment when it comes to a regular type of loan. The other types of loans are interest-only loans, adjustable rate mortgages, things of that nature. But those are also kind of along the same, very similar lines, if you will, on an amortizing type of loan. They're still front-loaded interest. And then you've got home equity lines of credit. Home equity lines of credit, they are going to have a 10-year draw period, and then they'll become a 20-year payment period to pay it off for the remaining 20 years after the 10-year period. And so, again, those types of loans are a much more costly endeavor, if you will. So what I try to explain to people when you're dealing with the all-in-one loan, whatever you know about loans, you don't know the all-in-one loan.
About the one though.
You got to switch your brain off to a whole different thing. Let's get in. I'm going to get into the brass tacks of the all-in-one loan. So the all-in-one loan is a first position home equity line of credit. It's an adjustable rate mortgage, so adjust every single month. It's an interest-only payment, but it's not in the same realm as what people think. What's unique about this particular loan is, one, it can be used for primary home, second home, investment home, and you can get loans all the way up to $3 million on this particular product. But what's unique about it is it has a non-balance holding sweep checking account that's actually attached to the line of credit itself. The servicers I was telling you about, we have 2 of them. One of them is going to be your primary servicer, and it's a full-fledged bank account. So it's going to be a checking account that doesn't hold money in it, but it's going to have debit cards, checks. You can do your wire transfers, all that kind of stuff, online banking, application banking. So it's just like your regular checking account, but what it does is you deposit and you funnel all of your cash flow money into the all-in-one account. And by utilizing your cash flow, it allows people, and it's not for everybody, it's people that are somewhat savvy or disciplined with their money to some degree, but it allows them to funnel all of their cash flow right into their line of credit to drive the balance down very, very quickly. What people need to understand is because you're driving the balance down so quickly, interest is not looked at in the same light. Interest on the all-in-one loan is actually calculated based on your daily balance. And so what you can do is you can actually keep track of your own interest every single day based on what your balance is every single day. And then what happens is once the end of the month is complete, they'll add all those days up together and they'll just tack it back on your line of credit balance on the 21st of the following month. So you got like 21 days to where your balance is not increasing whatsoever until the 21st. And all they do is they add the interest back onto the line of credit balance. So you're constantly keeping your balance at a lower level until the interest is added back on there. So, but what you do is you funnel your cash flow through this loan. So here's kind of I try to keep the math as simple as possible. And
you got slowed, so here we go.
yeah. So what I explain to people is, without getting into the meat and potatoes of the interest right now, we'll just say that you have a $500,000 balance that you currently owe on your all-in-one account. Okay. What you do is, let's say hypothetically you make 15 grand a month. Again, this is to keep the math simple. When the money is deposited into the checking account, it sits in there until the end of the day. And what it does is it sweeps directly over to the line of credit balance and it pays down the balance by 15 grand. No money is left in the checking account because it's swept over. So your balance went from 500,000 down to 485. Okay. So now your interest calculation is based on that lower number. Let's say your expenses equates to like 5 grand a month. So what happens is $5,000 is then withdrawn out of the line of credit, and now you owe 490. Well, we were at 500,000. We're now at 490. That means your positive cash flow was $10,000. So if you were to apply $10,000 every single month for the next 12 months, that's $120,000. If you do that in 2 years, that's $240,000. Well, our balance was 500,000. We now have applied 240,000. So in essence, we're almost 50% paid off in just a 2-year time span. So in 5 years, you should basically owe no money on your line of credit any longer. The all-in-one loan is good for 30 years. So let's say hypothetically, you're like, well, I want to go ahead and purchase an investment property for $450 as an example. Well, what they can do is they can cut a check and buy the house in cash for $450. And if it's going to turn out to be some sort of an investment home that you're going to collect money from a tenant, well, guess what? Your deposits are going to increase from 15 grand to something different. Depends. They're going to pay expenses. That's $1,000 and they're going to receive $2,000 in rent. Well, that's $1,000 that's going towards the principal now. We've already paid off. What happens if we tack on an extra $1,000 to that payoff? Well, it's going to be even faster. And it can start compounding. But what's great about it is because you're paying it down so quickly, it doesn't have time to accumulate. And this is my favorite part. The all-in-one loan has a simulator. It's available to everybody. I use the simulator when I first have conversations with the clients. So I'm able to actually plug in their actual cash flow to see, is this a program that's going to best fit their needs? And so other factor when it comes to like a traditional type of mortgage is people always tell me, they're like, well, what if I just apply extra money towards my regular mortgage to try to accomplish the same thing? Well, I just got done saying that we're applying 10 grand towards your principal on the all-in-one account. Principal.
Like, nope.
And they're like, well, no, I can't do that. And I ask them, well, why is it that you can't do that? A traditional mortgage is a closed-end loan. You don't have access to the equity when you need it. You would have to apply for some sort of line of credit to be able to gain access to it. But most people who do that, they don't treat their traditional HELOC like they would on all-in-one loan or even a traditional loan. Traditional loan, they're just putting in their monthly payment. That's it. The all-in-one loan, because you have access to the equity, you can take the risk of throwing all your money into that thing
Yeah,
because you still have access.
that's huge. That's a big
Yeah.
difference.
Big difference. And so a lot of people are like, well, that's the other unique part about the all-in-one loan is because you have access to the equity, heaven forbid, if you were to get let go of your job or something like that, if you were on a regular mortgage and you've been applying, let's say $2,000 each month towards your mortgage, towards the principal, and, it's $24,000 in a year that I could have had if I hadn't applied it towards my closed-ended traditional mortgage and I got let go of my job. Well, guess what? Your mortgage payment is still the same on a traditional mortgage. Well, with the all-in-one loan, as long as you have equity within the account, you can technically deplete from the all-in-one account as long as you stay under the line of credit and you only owe $200,000 on it.
So
You got
to
$800,000
play
you can
with?
live off of.
Yeah, I'm
That's
sure
like a
you got
plan.
plenty of time. That's like a
Exactly.
plan right there.
Yeah, and people are like, well, those could be riskier loans. Not necessarily. Like, first off, I'm not going to put somebody who makes 15 grand but spends 14 grand a month,
Yeah, of course.
because that is unrealistic.
Just not gonna work.
And it's just not going to work. And the simulator helps us figure that out too. So we run their budgets. We fit it within their lifestyle. And I am a big proponent on tacking on extra expenses to play it safe. And
Yeah.
all my clients, they call me up like a year later, like, man, I'm paying this off a lot faster than we expected. I was like, well, yeah, it's because I added like an extra $1,000 or $2,000 in the expense,
Just in case.
just in case.
Yeah,
And,
that's cool.
Yeah. So
That feels
it's,
good.
yeah. So for real estate agents, I try to explain to them, if you put your client into these types of loans, there's a high probability they're going to end up buying more homes. Not all of them are going to be on that kind of mindset, but they might buy 2 or 3, 4 homes just from the one loan. As a real estate agent, you could end up having a client who's buying multiple. But the great part is my clients now have their financial future in their own hands any
Trying
longer.
to get access to their own equity.
It's complete out of the equation now. So when I get, like, I did an all-in-one loan simulator just yesterday. I was doing a follow-up with one of my clients, and he's paid off granted, his loan now is at $215,000. I think it is now. He's going to be paid off in 1.8 years, and he's only paying $11,000 in interest. His APR based on the forecasted payoff and paying 11 grand was like 0.3% interest. Investment property.
Gotta love that.
Yeah. So that's why I've been such a big proponent. And even first-time home buyers, it just depends on them personally. So are you good with your money? Do you have budgets? Let's figure that out. It may or may not work for them, but at least they're aware of it. Because if I can put a first-time home buyer into an all-in-one loan where nobody else knew about this loan, I might change them.
Oh man, that'll set them up, especially like setting up if you're trying to be an investor or try to have multiple properties and just having that generational wealth, start building that generational wealth for your family. That's a awesome thing to be able to have at your disposal. So hopefully people come running, at least want to hear about it.
Yeah, I had a client and I just touched base with them. Actually, they texted me because they were like, hey, we need our title, our deed to our property. We paid off our loan already. I was like, wait, okay. I set them up about a year. It was a year and 2 months.
Okay.
And I got them on an all-in-one loan. I told them when we first started talking, because they're like, our goal is to pay this loan off as quickly as possible. I was like, okay, the all-in-one loan is all you guys. They're in their 30s. And they had already focused on their first home. We got them into the second home. 1.2 years. I think they only paid, I think it was like $7,000, $8,000 in interest, plus whatever the fees were associated with the loan itself, but it doesn't matter. Paid off in 1.2 years and they paid hardly any interest.
And you can do this as a refi too, huh?
Yeah, refis.
Cool.
Yeah.
So like is it the all-in-one loan a great option for financial advisors?
Yeah, so that's one of the biggest things is financial advisors are so accustomed to the traditional ways of doing things, the risk side of things that, they're prone to like interest-only ARM loans. Those are kind of concerning. But again, the all-in-one loan takes those concerns out of the way just because of the way it's been structured, along with the quick payoff. And I know some of them like to use it for tax strategies and stuff like that. But if they're not accumulating a lot of interest with this type of loan, I don't suggest the all-in-one loan for any sort of like the tax benefit unless the financial advisor gets involved and sets it up for some sort of a tax strategy. But The great part about the all-in-one loan is they have access to the simulator for their own clients as well. So they've got their CMR systems that they're going to try to come up with a financial investment strategy for their client. And then you've got the all-in-one loan that they can actually incorporate what their financial strategies are, including whatever their fees, something like that. They can account for that in the all-in-one simulator. So that way now they've got a full-fledged real estate transaction established. They've got all of their investment futures strategy figured. It's a one-stop shop. Cameron, as a financial advisor, they'd be like, Cameron, I've got our client. It's an all-in-one loan. This is what our tax strategy is. This is what we want on the all-in-one loan. Set them up. Done deal.
Oh, cool.
And now the financial advisor can put them into a better position, not only on the interest savings, but in their investment strategy as well. And they can use the simulator to their advantage to making it work. So
It's just all about getting them to go against what they're used to. Like, it's getting them to actually look at this product and realize that it's an actual, because I'm sure the first thing they're thinking, nope, absolutely not, or something like that, just because they don't know about it or they haven't heard about it yet. But
they're accustomed to the whole asset. Yeah, it's like, well, if you put all your eggs in one basket, that's no longer an asset because you applied it all on your mortgage. But if you have your mortgage, that's an asset right off the go based on its value. And then you've got your assets over here. And I get all that. The only difference, though, is the stress relief from having a paid off mortgage or putting you in a trajectory of having your house paid off quickly bodes well with most people. And in fact, I see a lot of podcasts. I see what people are saying.
Sure.
And the funniest part is when it comes to the strategy of always having a mortgage, so you have either a tax write-off or what have you. I'm not a financial advisor, but I look at the comments and everybody's like, I tell you one thing, having no mortgage is a stress relief.
Dude.
So,
it's one of those
completely
things you don't even like have in your mind happening in your lifestyle or your lifetime until you're like super old. So like even having this available, like you have to like switch your mindset. Like, wow, this is possible. Like I can have no mortgage and be a homeowner. Like, yeah, that's so crazy.
It's huge. And I talk about taking the stress out of a lot of different things. It's like, well,
That's
I'll go through the simulator. I'll plug in what my current income is. I'll put in what my current budgets are. What does the forecast look like? What are my results? You can tweak it. Yeah, a lot of my clients, they say they get into their head, oh, I'm starting to pay this thing down. What else can I do to change it to pay it down even quicker?
That's
So
awesome.
it's really interesting. But the best part is when I get that call, Cameron, I paid off my mortgage. It's like, what? Incredible.
That's so
It
cool.
works. So
Yeah, so for all you financial advisors out there and all you real estate agents, man, just hit up Cameron. This guy will get you hooked up to the
Simulator.
The simulator, yeah. Because that
Get
thing,
that
he
simulator
showed it to
working
me.
in
It's
your
awesome.
favor.
Yeah, I love it. I want you to simulate me just for see what happens.
Yeah,
Yeah. So how long does the loan application and approval process usually take, and what can a buyer do to speed it up? And is this this is in general, right? Not just the all-in-one, right?
Yeah, for the all-in-one loan, it can close rapidly, and the reason is it doesn't have any of the waiting periods tied to it. Traditional
cool.
sense, yeah. So in a traditional sense, when it comes to approvals, it's all same-day approvals typically. So pre-qualification, again, that's stated income. If they give me documents same day, I can get them pre-approved if everything checks out. We run the system and it looks good. Underwritten pretty well. Technically, we do have one extra option. If a client has automation for their employment and for their bank statements, we can use a program to actually have them log in for their employment and their bank statements, and we can do same day approval.
Wow.
And yeah, and that's huge. That's been real popular.
Are you talking about like have the direct deposits set up?
Yeah. Well, if all their system, we can use our automation system linked to their employment as well as for their bank statements on their employer.
Right, got it.
But if they do, there's a high probability we're just going to get a same day approval, and that's gold. If we have to submit it to an underwriter, it takes a day, maybe 3 at the most.
Not
And
bad.
so, but things are going to move very quickly
Fast, yeah.
in the process. Yeah.
Because I mean that's when you're going shopping for houses at that point, right?
I send out the congratulations and happy hunting.
That's perfect. Let the hunting begin.
That's the fun part. You
Heck
find.
yeah.
And when you find a house, you shouldn't be worried about the loan. It should be really your focus on your inspections and doing what the real estate agent is talking about and kind of going with the flow. As far as the loan is concerned, you shouldn't have to worry about the loan. Your lender should be taking care of that.
Yes. If you're having to worry about the loan and feeling like you're doing a lot for the lender, then you probably are. And it's time to find a new lender because you shouldn't have to talk to them very often if they're doing their part.
or the lender should be giving you up-to-date
On
information on
top,
this.
sure.
Yeah, you should be updated every day. Hey, this is where we're at. Even if there's nothing to update, I'll send a text message. Quick update, Dave, we're
Yeah.
still waiting for something.
I mean, it just
But
avoids them calling you anyway. They're gonna like, who wouldn't reach out? Even if like
Yeah.
it's such a big thing to do. That's very cool. I'm glad that you do that. What advice would you give to someone who's nervous about taking on such a large financial commitment?
don't be nervous. The only reason I say that is because, again, I work within their budget. What is a comfortable monthly payment, not their max purchase price? And I even tell the agents, it's like, listen, yeah, they're approved for $800,000, but their comfortable payment range, we want to keep them at 600,000. So as long as you've got a good sound lender who's going to give you sound advice and he's going to do what you're asking them to do, then it should not be stressful at all. It's a big deal. This is home ownership. It's a life-changing event. As long as you've got the right lender on your side, you got the right real estate agent on your side, I mean, it should be seamless, not a problem.
Seamless for sure. I agree.
Yeah. So the other thing about checking with the loan officers and asking questions is, like, for us, we have specialized rate programs called like rate rebound. So when rates start to drop, we're actually covering loan origination charges, appraisal fees, credit report fees, things of that nature. With rate rebound, we can use it as often as we need to within 5 years of your close of escrow date. There has to be a 0.5 point decrease on the rate, as well as 6 months separation between refis. We also offer other programs that nobody else offers. So we have like our list and lock program. So if this listing agent and the seller is having a hard time selling their home because maybe they're competing with a builder who's offering a preferred lender rate that's significantly lower than the market, well, list and lock it's accomplishing the exact same thing. You go on our website, on the list and lock website, you can put in the property address, put in what kind of concessions the seller's willing to come in with, and we'll offer actually significantly lower rates. And CMG actually incorporates some concessions to help on that rate. And so now you can market it on your MLS, on your website, social media, so people can see it. So you're competing with the builder. We also have another program called Home Funded. So if you're going to get married or you got like a big life event,
Yeah.
Home Funded is like a crowdsourcing, a GoFundMe account. And you can actually receive gift funds from acquaintances, friends, people that are not family.
That's a good
And
idea.
you store it into a specialized escrow account. And then CMG also incorporates money. For every $1, we'll put in $2 that goes towards their closing cost, obviously.
Yeah.
Up to $2,000. Another
That's
great
big.
down payment program, especially when somebody's like, yeah, we're going to have a baby. It's like, oh, let's set you up on a home funded account.
Yeah.
Real estate agent's tied to it. And
Oh,
the
cool.
agent can also,
Very cool.
do a crowd fund, for their clients.
That's
That's just
awesome.
the tip of the iceberg. I've done some crazy homes that are on 63 plus acres with 20,000 square foot indoor arenas,
Dang.
like 8 horse stalls. Like nobody could close escrow on it. And I got a call from an agent. He's like, Cameron, can you do this? Let me find out for you. And I reached out to our internal broker and they're like, we'll buy this loan from you, Cameron. I was like, okay. And we closed escrow on it. So
Wow, very cool. Cameron, I can't thank you enough for coming on here. You've provided so much value. Your all-in-one loan program is amazing. Thanks again for coming on the show.